There are at least 5 Social Security decisions the average American makes or fails to make that permanently reduce the monthly check they'll receive. For the rest of their lives, permanently. Not temporarily, not until you appeal it, not until someone corrects it. The Social Security Administration doesn't call you up and say, "Actually, we think you left money on the table there." That's not how any of this works. Once you've locked in certain choices, you've locked them in. And the part that keeps me up at night, the part I want you to really hear before we go any further, is that the mistakes that cost people the most aren't made by people who were careless or uninformed. They're made by people who thought they understood the rules, did what seemed sensible, and walked away not knowing they'd just handed back tens of thousands of dollars they were fully entitled to keep. I'm going to walk you through all 5. Not in vague terms, not with a lot of "it depends," and consult your advisor hedging that tells you nothing. Plain English, real numbers, and for each one, I'll tell you exactly what the mistake looks like, who it hits hardest, and precisely what you do instead. And stay through to the end, because the 5th one is the one that gets the people who've already avoided the first 4. The people who've done their homework. The careful ones, they're the ones who fall into it most reliably, and I'll explain why. But first, I want to clear up the single biggest piece of conventional wisdom around Social Security that does more damage than almost anything else, because it's the reason mistakes 2, 3, 4, and 5 happen at all. The idea that claiming early is the safe move. You hear it constantly. Take the money while you can. What if you die before you break even? Don't leave it with the government longer than you have to. And I understand the instinct. It feels prudent. It feels like you're protecting yourself. I'm going to show you why. For the majority of Americans reading this, it is the single most expensive piece of financial caution there is. But we'll get to that in a moment, because there's a mistake that costs people money even before they claim a single dollar. And that's where we start. Mistake number 1. You don't know what your actual full retirement age is, and you've been planning around a number that isn't yours. Most Americans, when asked what age they can claim full Social Security benefits, say 65, it's deeply embedded. Medicare starts at 65. Retirement accounts have rules around 59.5, and 65 just feels like the number. It isn't. Not for the overwhelming majority of people who will watch this. Full retirement age, which the Social Security Administration calls FRA, was changed by Congress in 1983, and it's been phasing upward ever since. If you were born in 1955, your FRA is 66 and 2 months. Born in 1956, it's 66 and 4 months. It keeps climbing in 2-month increments until you hit 1960 or later, at which point your FRA is 67. And this matters enormously because every single rule about reductions increases spousal benefits. And the earnings test is calculated relative to your FRA, not 65, not 66, your specific FRA if you don't know it precisely, and I mean not roughly, precisely, you're doing your planning on a faulty foundation. Everything downstream will be slightly or significantly wrong. I'll give you a real example. A woman, I'll call Patricia, 63, a retired school administrator in Ohio. She'd sat down with a notepad and worked out what she called her break-even age, the point where waiting to claim would be worth it versus taking the money at 62. Her math was reasonably careful, but she'd done the whole calculation against age 66, assuming that was her FRA. Her actual FRA was 67. She was a year off in every single number. When we redid the calculation with the correct FRA, her break-even age shifted. The reduction she'd accepted by claiming early was larger than she'd understood, and the optimization we could still do on her husband's benefit changed entirely. She hadn't done anything silly. She'd done something very human. She'd used the number she thought was right without ever checking whether it was. So here's what you do, and it takes about 3 minutes. Go to sah.gov, create or log in to your My Social Security account, and look at your statement. Your personal FRA is printed right there. While you're in the account, look at your earnings history. Check it for errors, missing years, or years where your income looks lower than it should, because your benefit is calculated from your highest 35 years of earnings. And if any of those years are wrong in the record, your benefit is wrong. People find errors in there all the time, particularly around years they worked multiple jobs, had a name change, or switched employers mid-year. Correcting the record before you file is straightforward. Correcting it after you've already been receiving payments is significantly less so. That's mistake number one, and it's the foundation everything else rests on. Mistake number two, you claimed at 62 because it felt like the safe thing to do. This is the big one. This is the one I said we'd come back to, and I want to give it the full space it deserves because it affects more people and more retirement income than anything else on this list. The numbers are stark, so let me just put them in front of you plainly. If your full retirement age is 67 and you claim at 62, the earliest possible age, your benefit is reduced by 30% permanently for the rest of your life. If your benefit at 67 would have been $2,000 a month, claiming at 62 gives you $1,400 every month for however many years you live. And that's before inflation adjustments, which compound on top of your base rate. Meaning the 30% reduction also applies to every cost of living increase you receive for the rest of your life. The gap widens every year. Now flip it. If you wait past your FRA until 70, you earn what are called delayed retirement credits, 8% per year, guaranteed. No market risk, no volatility, no counterparty risk. Just 8% added to your benefit for every year you wait past FRA, up to age 70. Using the same $2,000 FRA benefit, waiting to 70 gives you $2,480 a month. Compare that to the $1,400 you'd get by claiming at 62, and the monthly difference is $1,080. Across a 20-year retirement, that's over $250,000 in cumulative benefit before any COLA adjustments. The break-even point, the age at which waiting pays off more than claiming early, typically falls in the late 70s, depending on your specific numbers. And here's what the actuaries at Social Security know that most claimants don't. The average American who reaches 62 healthy today lives well into their mid-80s. The majority of people who claim early in the belief that they might not live to break even actually do live past it. They just never knew, because nobody ran the numbers with them out loud. I know the counter-arguments: what if I need the money now? What if I die before I break even? What if I have health problems? These are legitimate, and I'm not dismissing any of them. There are real situations: a serious health diagnosis, genuine financial hardship, a job you hate and can't continue, where claiming early makes absolute sense. But those are specific circumstances. The mistake I'm describing is claiming at 62, not because of any of those things, but because it felt like the cautious move, because of a vague sense that the money is safer in your pocket than in Washington. For the majority of Americans with reasonable health and the option to wait, that feeling costs them more than almost any other financial decision they'll make in retirement. Let me give you a name. A gentleman I'll call Robert, 71, retired electrician from outside Pittsburgh, claimed at 62. At the time felt right, had some savings, wanted to stop working, didn't think too hard about it. By the time we met, he was receiving $1,510 a month. His FRA benefit would have been $2,160. Waiting to 70 would have given him $2,680. He was 7 years into retirement. The cumulative gap to date was over $90,000. Nothing to be done at that point. He knew it. I'll tell you the thing he said that I've never forgotten. I didn't know I was making a decision. I thought I was just picking up my check. So what do? If you haven't claimed yet, run your own numbers at SY.gov or through a tool like ARP's Social Security Calculator. Model the break-even explicitly, not just the monthly amounts. And if you're still working, even part-time, know that claiming before your FRA, while still earning income, brings in a separate problem, which is exactly what mistake number 3 is. Mistake number 3, you claimed early while still working and lost a chunk of your benefit to the earnings test without anyone warning you. This one is particularly cruel because it catches people who are in what sounds like a great position. They're still earning, they're active. They've hit their early 60s and decided to claim Social Security to supplement the income. Sounds fine. Here's what the Social Security Administration does that almost nobody explains before you claim. If you claim before your full retirement age and you're still working, there's an earnings limit. For 2025, it's $22,320 in gross wages or self-employment income. If you earn more than that, Social Security withholds $1 in benefits for every $2 you earn above the limit. So if you're bringing in $42,320 at a part-time job, that's $20,000 over the limit. And Social Security is going to withhold $10,000 of your benefits for the year. $10,000 you were expecting to receive, gone. Now, to be scrupulously fair, those withheld amounts aren't entirely lost. When you reach your FRA, the Social Security Administration recalculates your benefit upward to partially credit you for the months it withheld payments. So some of that money does come back in the form of a slightly higher monthly check for the rest of your life. But here's what people miss. The recalculation is partial, not complete. And you've been living on less than you planned during what may be a period when you genuinely needed the money. The damage isn't total, but it's real. It's unexpected, and it is completely avoidable if you know the rule before you claim. In the year you reach your FRA, the earnings limit jumps significantly to $59,520 for 2025, and the withholding rate drops to $1 for every $3 above the limit. Once you hit your actual FRA birthday, the earnings test disappears entirely. You can earn any amount you like with no effect on your Social Security check. So the sweet spot, the rule that almost nobody explicitly states, is this. If you're still earning meaningful income, waiting until at least your FRA to claim eliminates the earnings test problem completely, and waiting further gives you those delayed retirement credits on top. The two mistakes stack, which is why the people who fell into mistake 2 are often unknowingly also inside mistake 3. Mistake number 4, you didn't coordinate spousal benefits, and one of you left significant money unclaimed. Social Security is, among other things, a couples system. It has built-in protections for lower-earning or non-working spouses that are genuinely generous and genuinely complicated. And because nobody sits you down and explains how they interact, a significant number of married couples optimize one spouse's benefit while effectively ignoring the strategies that govern the other. Here's the basic rule. A spouse who either didn't work or earned significantly less than the primary earner is entitled to a spousal benefit, worth up to 50% of the primary earner's ROA's FRA benefit, not 50% of what the primary earner actually claimed. 50% of what their benefit would have been at their full retirement age, regardless of when they actually filed. That's an important distinction. If the primary earner's FRA benefit is $2,800, the spousal benefit cap is $1,400, even if the primary earner claimed at 62 and receives only $1,960 themselves. Now, the strategic implication that most couples miss, because survivor benefits what the surviving spouse receives after one spouse dies, are based on what the deceased spouse was actually receiving at death. The primary earner's claiming age affects 2 lifetimes of income, not just one. If the higher earning spouse claims early, reduces their benefit by 30%, and then dies first, the surviving spouse steps into that reduced benefit and potentially lives on it for 20 years. The decision that felt like it only affected one person turns out to have locked in the other person's income floor for the rest of their life. The implication is almost always that the higher earning spouse should delay as long as financially possible, not necessarily to maximize their own benefit during their own lifetime, but to maximize the survivor benefit that the lower earning spouse will receive. It's a form of longevity insurance that the Social Security system provides essentially for free, and most couples never think about it in those terms because they're each thinking about their own check rather than the combined household strategy. Let me give you a case to make this concrete. A couple I'll call Diane and Frank, both 63, married 38 years, just retired. Frank was the primary earner. Diane had worked part-time most of her career. They'd planned for both to claim at 62 when we looked at it together. Frank's FRA benefit was $2,900. Claiming at 62 would give him $2,030. Diane's own earned benefit was $680 at FRA. Her spousal benefit was $1,450. Neither of those strategies was wrong in isolation, but the combination was, if Frank claimed at 62 and died first, Diane would step into his $2,030 benefit. If Frank waited to 70, she'd step into $3,596. The difference in her monthly income as a surviving spouse was over $1,500. A month on a fixed income with no way to make it up. They changed the plan. Frank went back to part-time work for 4 more years to delay claiming. Diane claimed her own small benefit early to give them some income in the interim. That's a legitimate strategy. By the way, claiming the smaller benefit early to generate cash while letting the larger benefit continue to grow. It's not cheating, it's coordination. And it's something hundreds of thousands of married couples never do because nobody ever laid the whole board out for them at once. Mistake number 5. You have everything else under control and you've forgotten about taxes. This is the one I told you about at the beginning, the one that gets the careful people. You've learned your FRA. You've thought hard about when to claim. You've coordinated with your spouse. Your paperwork is clean. And then you get your first year of retirement taxes back from your accountant, and there's a number on there that you weren't expecting, because up to 85% of your Social Security benefit is potentially subject to federal income tax. And a significant portion of retirees have no idea this is coming. Here's how it works. The IRS calculates something called combined income, which is your adjusted gross income plus any non-taxable interest, plus half of your Social Security benefit. If that combined income number is between $25,000 and $34,000 for a single filer, up to 50% of your benefit may be taxable. Above $34,000 for a single filer, up to 85%. For married couples filing jointly, the thresholds are $32,000 and $44,000. Those thresholds were set in 1984 and 1993 and have never been adjusted for inflation. In 1984, they captured a small percentage of beneficiaries. Today, because wages, savings, and Social Security benefits have all risen dramatically, while the thresholds haven't moved. Over half of all Social Security recipients pay federal tax on their benefits, and most of them discovered this the first time they filed a tax return in retirement. Not before. Now here is where it gets particularly expensive for people who are otherwise doing things right. If you've saved diligently into a traditional 401k or traditional IRA throughout your career, those accounts are tax deferred. Every dollar you pull out in retirement is ordinary income. And if you're drawing from those accounts at the same time, you're receiving Social Security. Your combined income can push you well above the thresholds, even on a moderate retirement income. The traditional account withdrawals don't just get taxed themselves, they cause more of your Social Security to get taxed as well. Effectively, one withdrawal triggers two tax events simultaneously. The move that most people in this position have available to them, but only during a specific window, is the one I want to leave you with. In the period between retirement and when you're required to take mandatory withdrawals from your traditional accounts, which start at age 73 under current law, many retirees are in the lowest income tax bracket they will occupy for the rest of their lives. Salary has stopped. Social Security may not have started. Required minimum distributions haven't kicked in yet. That window, which can be anywhere from a few years to a decade, depending on your situation, is the cheapest tax room you will ever stand in. And the move that makes the most of it is converting portions of your traditional IRA to a Roth IRA each year, in amounts that keep your combined income below the Social Security taxation thresholds, or at least in the lower tier. You pay tax on the conversion at today's lower rate. The converted money grows tax-free. Future withdrawals are tax-free, and critically, they don't count as combined income, so they don't drag more of your Social Security into the taxable column. This isn't exotic. It isn't aggressive. It's just using the rules as they're written, during the brief window when doing so is least expensive. And almost nobody does it because almost nobody knows the window exists or that it closes. I'll tell you about a man I'll call Gerald, 74. Retired engineer from Arizona, careful as they come. He'd delayed Social Security to 70, done everything right on the claiming side. But he'd left everything in his traditional 401k because he'd been told correctly that it grows tax-deferred. He hadn't thought about what deferred actually means, that the bill wasn't gone, it was waiting. His RMDs at 73 pushed his combined income to $71,000. 85% of his Social Security benefit was taxable. He was paying ordinary income tax on both simultaneously. When we looked at what a Roth conversion strategy in his early retirement years would have cost versus what he was now paying indefinitely, the number was uncomfortable. Not catastrophic, but uncomfortable, and entirely preventable if the concept of the conversion window had been explained to him before the window closed. Gerald knew everything about when to claim. Nobody had ever sat him down and told him that knowing when to claim was only half the game. The other half is managing what happens to the check after it arrives. So those are the 5. You don't know your precise FRA, and you're planning around a wrong number. You claimed early because it felt safe, and you've permanently reduced not just your benefit, but in many cases your spouse's survivor income as well. You claimed, while still earning and lost money to the earnings test nobody warned you about, You didn't think about your spouse's benefit as part of a coordinated household strategy, and you didn't manage the tax exposure in the window that briefly existed to manage it cheaply. Every single one of those mistakes is invisible. There's no letter saying you've made one, no penalty in the traditional sense, just money that doesn't arrive month after month for the rest of your life. Because of decisions made once, often quickly, with incomplete information. Here's the thing I want to leave you with, and it's the same thing underneath all 5 of these. Social Security was designed as a system, not a menu of independent choices. The age you claim interacts with your spouse's strategy, which interacts with your other income sources, which interacts with your tax exposure, which affects your Medicare premiums, which loops back around to your net monthly income. Every piece touches every other piece. The people who come out of this system with the most are not necessarily the ones who earned the most or lived the longest. They're the ones who understood that the decisions are connected and made them that way. You now have the map. The decisions that seem separate aren't. The window to make them cheaply doesn't stay open. And unlike a missed deadline you can fix next year, the choices this system asks you to make are mostly permanent. If this was useful, do one thing for me. Send it to someone in your life who's within 10 years of retirement and hasn't sat down with these numbers yet. A parent, a sibling, a friend who mentioned they're thinking about claiming soon. It costs you nothing, and it might be the most valuable thing anyone puts in front of them before they make a decision they can't unmake. The money is there. The rules say so. But the rules also say it stays exactly where it is unless you understand them well enough to act.